I'm going to show you how to assess the risk level of stocks, how to measure a stock sensitivity to market movements, and how to estimate the expected return on a stock. If you are an investor or a portfolio manager, these will help you to make informed decisions about which stocks to include in your portfolio. So here, I am working with the opening prices of stocks from Apple and Qualcomm. And I also need the stock prices of a market index for which I have chosen the S&P 500. We have monthly data of each of them of up to 5 years here from 2019 to 2024. So first of all, what we need for these calculations is the log return. It is a method of calculating the return on investment that takes into account the compounding effect over multiple periods. Log return is particularly used for financial modeling and analysis because it simplifies the math for compound returns, and you'll see that it will make it easier for us to do the calculations here. So the formula to calculate log return is equals to ln, open bracket, the price of the asset divided by the price of the asset at the end of the period, and enter. This price divided by this price. And then if you just double click, you'll see the rest of the returns. The same process will be done for QCOM and the index. Remember to have your answers to 3 decimal places at least. This one divided by the one on top. Now that we have this, let us come to the actual calculations. First, I have to do the arithmetic average return of the individual stocks, which is the mean. I am going to do Apple first. So the formula of average is equals to average, open bracket, and you choose the whole array of log returns that we just found out, and then enter. We have our average return. The same process will be done for QCOM and the index. Average, this whole array, and enter. Then up next is the risk of each individual stock, which is basically the standard deviation. What this means is it measures how spread out the data is from their mean. We have found out the average return. Now we need to know how spread out all of these prices are from this average. And the mean that we're going to compare with all will be the index mean here, this one, because it is the market average and serves as a benchmark for comparing individual stocks. I'll explain further after the calculation. So the formula for standard deviation here is STDE, and we're going to choose the one with S, open bracket, and in the same way, I'm going to pick the whole array of our log returns and enter. Let's keep it to 3 decimal places. STD. We're doing it for QCOM now. This whole array and enter. Here. So in finance, the standard deviation or risk measures the volatility of an investment's returns. The higher standard deviation means the prices are more spread out from the market average, which also means greater inconsistency in returns, eventually meaning higher risk. So in short, it can be said, higher the standard deviation, higher the risk of a stock is. This can mean the investment's return can deviate significantly from the average return, leading to potential for both higher gains and higher losses. On the other hand, a low standard deviation will tell us how closely clustered the data is to the market average, which means less inconsistency and lower risk. So what we can see here is that the deviation of Apple is 0.086. Let's put it here clearly. It is 0.086. And our index mean is this. Clearly, the deviation is higher than the mean, which means that the risk of the Apple stock is high and the stock is more volatile than the overall market. In the same way, let's compare for QCOM now. The standard deviation is 0.101 and the mean is the same 0.010. Same here, the deviation is more than the market average, which means the risk of QCOM stock is also high and more volatile than the overall market. Let's put these in red to demonstrate high risk. So in conclusion, higher standard deviation equals to higher risk. Higher standard deviation equals to higher risk. When a stock's standard deviation is higher than the market average, it is considered riskier because its returns are more unpredictable. Next, we are calculating the systematic risk of the stocks compared to the market, as in stock sensitivity to market's movements. This also means that portfolio's instability, which is measured by beta coefficient. So to find out the beta coefficient, we have to do regression. So to start a regression, we need an independent variable and a dependent variable. The dependent variable is the variable that is being measured, and the independent variable is a variable that stands on its own. Variable. So here, let's take the index as the independent variable, since we're using the market average for comparison, and let this be X. And the dependent variable would be the other two stocks, which is, let this be Y. Then from the data ribbon here, click on data analysis. If you don't have this function, some of you might not, you can go to options and manually select the add-on. Go to File, Options, Add-ins, and then press Go. And then you just need to select the analysis toolpath from here and press OK. And you will have the data analysis function. So let's go here and then we choose regression because that's what we're doing. Then for Y, as Y is our dependent variable, let's do Apple first. We choose the whole log return of Apple. And then for X, as X is our independent variable and the index. So let's go here and you make sure you have labels ticked on and then okay. Let's see the coefficient here. This is our beta coefficient. Let's copy this. Yeah, this is our beta coefficient for Apple. Now let's do the same thing for QCOM. Data analysis, regression, okay. X remains the same because it is independent variable on our index. Y is our dependent variable. This will be coupon here. Labels are ticked on. Okay. And here we can see it is our beta. Okay. So the rule here is if a beta coefficient is more than 1, it indicates that the stock is more volatile than the market and it is an aggressive stock. And if a beta coefficient is less than 1, it means the stock is less volatile than the market and it is a defensive stock. So since both of them are more than 1 here, it proves that they are more volatile than the market, meaning their changes in the market are usually unexpected and they are both aggressive stocks. So let's put this in red as well. Then we need to find out the expected return from a stock. And for that, we are going to use the capital asset pricing model, CAPM. The capital asset pricing model is a financial model used to determine the expected return on an investment, considering its inherent risk compared to the market as a whole. It helps investors assess the potential return on an asset, factoring in the risk-free rate, the asset sensitivity to the market movements, which we already calculated, the beta, and the overall market return. The formula here is, let's copy this formula so it is easier for us. It is risk-free rate plus beta number into index average minus risk-free rate. So here we already have found out the beta number here. And we also have the index average. What we need here is the risk-free rate. So the risk-free rate is the minimum return that investors expect for any investment because they would not accept additional risk unless the potential rate of return is higher than the risk-free rate. The risk-free rate is a theoretical concept as almost no investment is completely free of risk. In this case, government securities are typically used because they are backed by the government and thus considered very low risk. This rate keeps changing though, so let's see the latest rate. For that, go to Google and search risk-free rate treasury bond. Treasury bonds, yeah. And then see the 10-year treasury rate market. Here we can see the rate is 4.2%. The risk-free rate is 4.2%. Let's put it here so that we don't forget. Risk-free rate is 4.2%. Okay, now we just put it in the formula. The risk-free rate plus beta number of Apple multiplied by the index average minus the risk-free rate. 0.37%. Then again for coupon, 0.25%. So the expected return on Apple's investment is 0.37%, and the return on QCOM is 0.25%. Now, this expected return will help you investors set realistic expectations for the returns you should seek from your investments, and will also help you assess which stocks are high risk investments. Here, whatever amount you invest in Apple, you can expect a 0.37% return. As in, if you invest $10,000, you would expect to earn $37. That's it. Hope you enjoyed this video.